The most dangerous word in finance is not crash, it is permission. Most people think they own their money because they can see a number on a screen. They think they own their gold because they have a receipt. They think they own their retirement because the statement arrives on time. They think they own their house because their name is on the deed. What they often own, in practical terms, is access that exists only while the system around them continues behaving normally. That is a very different thing. I have spent most of my life thinking about capital control and the strange distance that can open between legal ownership and real-world usefulness. The older I get, the more I believe ordinary people misunderstand not only risk, but the shape risk takes when institutions grow strained. They imagine theft as something theatrical, a robber, a hacker, a market crash, a visible disaster. But some of the most painful losses in financial history were not robberies in the ordinary sense. They were interruptions, freezes, conversions, confiscations dressed up as policy, limitations explained as temporary necessity. Access delayed long enough to change a household's life. That is what people miss. A man can be right about the value of his asset and still lose years of peace because he misjudged the structure standing between him and that asset. If you want to understand why I take this so seriously, you should begin with a simple fact. The world is full of assets that look safe until the day access matters more than valuation. A family may have hundreds of thousands of dollars in the bank and still discover, under stress, that the relevant question was never the balance. The relevant question was how many institutions, policies, rules, and decisions stood between that family and immediate use of the money. People learn this too late because normal times hide it. Normal times make dependence feel like convenience. The app opens, the transfer clears, the debit card works, the safe deposit key turns, the brokerage login loads, the retirement portal updates. Everything is smooth. Smoothness teaches bad habits. It teaches people to confuse system reliability with personal control. I do not make that mistake anymore. I have watched too much history. I have watched governments, banks, markets, and human beings long enough to know something very plain. When pressure rises, rules are interpreted differently. Not always unfairly, not always maliciously, but differently. The public hates that truth because it wants financial life to feel morally simple. If the asset is mine, then access must be mine. If the statement says I own it, then control must be complete. Real life is not that tidy. In a crisis, what matters is not only what is yours, what matters is how quickly, legally, practically, and independently you can use it. That is the distinction I want burned into your mind. Ownership is one layer, control is another, liquidity is another, visibility to institutions is another, counterparty dependence is another. A wise person never treats those layers as identical. Let me begin with a small island, because sometimes history explains the future by humiliating our assumptions in a very compact place. In Cyprus, during the banking crisis, savers with balances over insured thresholds learned a lesson that felt impossible before it happened. They thought money in the bank was cash. It was not. It was an unsecured liability of a weak institution sitting inside a political system that had decided some depositors would help absorb the pain. The people did not wake up to a thief in a hallway. They woke up to a rule. That is how modern financial pain often arrives. Not with a criminal, with paperwork. People love to dismiss such examples by saying that was another country, another era, another tiny system, another special case. Fine. Then take another example in 1933. The United States government did not ask gold owners for philosophical agreement. It ordered private gold turned in under legal authority. People can debate the historical context. They can explain the monetary stress of the time. They can describe the arguments. None of that changes the core lesson. An asset can be legally yours and still be brought under state control when the system decides the emergency is large enough. Or take a more modern case. Many people believe that crypto, by its nature, sat outside ordinary reach. Then they discovered that if the coins were on an exchange, the exchange could comply with government orders faster than the slogan about freedom ever could. The technology may have been new. The counterparty problem was ancient. This is what history keeps saying in different voices. Do not confuse the asset with the channel through which you access the asset. That principle alone can protect a person from a great deal of foolishness. Now let us talk about the asset ordinary people trust most: cash in the bank. People speak about bank deposits as though they were money in a vault with your name floating above it. That is not what a deposit is. A deposit is a claim. A bank owes you. Most of the time that distinction feels academic because the system is functioning normally. But the distinction becomes painfully real when the institution is strained, when a levy appears, when a transfer is delayed, when a fraud alert locks everything, when an administrative hold is placed, or when the bank itself becomes the subject of emergency management. I am not telling you to fear every bank. I am telling you to stop trusting concentration. A bank account is a wonderful convenience tool. It is a terrible place to put all of your assumptions about safety. The first rule of sane liquidity management is simple. No single institution should have the power to interrupt your entire household. That sounds more dramatic than it is. It is only common sense. If every bill, every emergency, every payroll function, every mortgage payment, every card, every transfer, and every reserve sits under one roof, then you are not organized, you are concentrated, and concentration in liquidity is a dangerous form of laziness. I do not want the average family spreading itself across 10 banks like a frightened spy novel character. I do want that family to understand insured limits, ownership categories, account titling, and institutional concentration. A married couple, a business owner, a retiree, a family caring for an older parent, all of them should know exactly what sits where, under what title, and under what protection. Most do not. That ignorance is expensive. The same people who would spend hours trying to save $50 on a car repair have no idea whether a large share of their liquid life sits above sensible insured thresholds at one institution. That is absurd behavior. I would rather see a family with slightly lower yield and much better control than a family reaching for a few extra basis points while building hidden fragility. Liquidity exists for calm, not for optimization contests. Now, some people react too hard when they hear this. They say, all right, I will just pull everything out. That is another foolish extreme. Cash outside the system has uses. It also has limits. Physical currency does not compound. It can be lost, stolen, damaged, or mismanaged. The intelligent solution is not theatrics. It is layers. Some liquidity should be in ordinary operating accounts. Some should be in separate reserve accounts. Some may belong in direct short-duration government obligations where appropriate. A modest physical cash reserve for temporary disruption can make sense for some households. But the point is not drama. The point is that your household should be able to function through a period of banking friction without becoming a beggar to the same institution that created the friction. That is the real standard. The next great illusion is the safety deposit box. I have always found the name charmingly persuasive. Safe deposit box. It sounds like the language of final security. Put your valuables there, lock them away, and the system itself will honor the arrangement forever. Perhaps until it does not. The difficulty with anything housed inside a bank building is simple. Access can be interrupted by the same event that made you suddenly want the asset. That is what people miss. If your important documents, emergency metals, family heirlooms, or critical backups are in a place you cannot enter during a banking holiday, investigation, closure, access restriction, or institutional disruption, then the problem is not whether you technically own them. The problem is that practical use and legal ownership have parted company. I am not telling people never to use a safe deposit box. I am telling them to stop treating it like the same thing as personal control. Important originals should have copies elsewhere. Critical access information should not all live in one place. Anything you might need quickly during a system disruption should be evaluated under one harsh question. Can I reach it when reaching it suddenly matters? That question changes behavior. It makes you think about document redundancy. It makes you think about digital backups. It makes you think about beneficiary lists, passwords, contact trees, and the boring but necessary work of keeping your life's operating manual outside a single physical point of failure. I have met too many intelligent people who organize their finances as though continuity were guaranteed. Continuity is a privilege. Systems earn it until they do not. That is why redundancy matters. Now let us move to the asset Americans are emotionally most tangled up with. The house. A paid-off house feels like freedom. Sometimes it is concentration, illiquidity, maintenance burden, tax exposure, and false confidence wearing a very respectable face. I like home ownership when it matches the life and when the economics make sense. But I dislike lazy thinking around home equity. Home equity is not cash. It is trapped value attached to taxes, repairs, legal exposure, insurance, and the physical reality of a structure that can easily become more expensive than the owner expected. A person can sit in a house he owns free and clear and still be far less secure than he imagines Property taxes remain, insurance remains, maintenance remains, legal claims can still arrive, local assessment errors can still overcharge him. Storm damage can still reorder his life. A roof does not care whether the mortgage is gone. That is why the truly mature homeowner thinks not only about ownership, but about resilience. Do the tax assessments make sense? Is title clean and properly structured? Are beneficiary and transfer issues addressed? Is the insurance adequate? Would the family know what to do if the owner became incapacitated? Would heirs be able to navigate the paperwork? Does the owner have liquidity outside the house, or is he house rich and operationally thin? These are not glamorous questions. They are adult questions. The same rule applies here. Do not confuse value with control. If most of your net worth lives in a single illiquid asset and a modest tax or legal problem could still disrupt your peace, then you are not as fortified as the Zillow estimate would like you to believe. I want homeowners to become a little less enchanted by gross equity and a little more serious about usable optionality. Sometimes that means simplifying. Sometimes it means checking assessments. Sometimes it means raising umbrella coverage. Sometimes it means updating title arrangements or estate documents. Sometimes it means doing nothing more dramatic than understanding what the house actually costs to keep secure, liquid enough, and properly defended. That is wisdom. And it costs far less than the common American habit of admiring equity while ignoring the structure around it. Then we come to retirement accounts here. Again, the public confuses tax advantages with full sovereignty. A retirement account is a marvelous invention when used properly. It defers taxes, shelters compounding, and forces future thinking on a culture designed to worship the present. I have no quarrel with them. I want more people to use them intelligently. But a retirement account also lives inside rules. Rules about access, rules about withdrawal, rules about beneficiaries, rules about taxation, rules that can change if you place every hope for your future inside one type of account, one tax treatment, one policy assumption, and one future legislative environment. You may be making a concentration decision without realizing it. This is why I like diversification, not only of assets, but of account structure. Taxable accounts, retirement accounts, Roth structures where appropriate, some liquidity outside the retirement shell, some flexibility. The exact mix depends on age, income, tax bracket, and planning horizon. But the principle is sound optionality in account type is a form of resilience. It prevents your entire future from being governed by one rulebook. The other great retirement mistake is failing to maintain the boring administrative layer. Outdated beneficiaries, no power of attorney, no trusted person who knows where things are, spouses who do not understand account locations or withdrawal mechanics, children who have no map. This is negligence disguised as ordinary life. The richest widow can still feel poor if the structure is a maze. The wealthiest family can still create chaos if the records are sloppy. You want retirement capital not only growing, you want it legible, understandable, transferable, protected by clean documentation and good counsel. The same principle extends into the world of digital assets. People hear phrases like self-custody and decentralization and think the entire problem has been solved. It has not. The problem has changed form. Crypto held on an exchange is still counterparty dependent. That is a simple truth. If you choose to own digital assets, then custody matters. But even lawful self-custody has its own requirements. Records matter, tax compliance matters, operational discipline matters, beneficiary planning matters. If your heirs cannot find it, understand it, or lawfully access it, you may have created an island of control so isolated that it became a form of disappearance. This is why I dislike ideology and asset protection. What matters is not whether something sounds rebellious. What matters is whether it is lawful, usable, documented, and aligned with the actual needs of your household. A person who uses crypto lawfully, stores it responsibly, maintains records, and understands the difference between exchange risk and personal custody is behaving intelligently. A person who mistakes opacity for safety is just creating a future headache for himself or his family. The same is true of precious metals. I understand why people are drawn to them. They are a hedge against monetary misbehavior, counterparty distrust, and long-term debasement. Fine, but do not buy metals as though the purchase itself solved your entire defense problem. Access matters, storage matters, insurance matters, records matter, household awareness matters. A metal you cannot find, prove, protect, or pass on cleanly is not being managed wisely. This is why I keep coming back to one phrase: lawful control. Not fantasy, not slogans, not hiding from shadows. Lawful control. That means you know where things are, how they are titled, who can access them if you cannot, and what institution, government, custodian, or rule stands between the asset and practical use. Once you start thinking this way, ordinary life begins looking very different. The strongest family is not always the one with the largest gross net worth. Often it is the one with the cleanest structure, the one that can lose one institution without losing its life rhythm, the one that can survive a week of banking disruption, a month of legal confusion, a transfer problem, or a broken platform without financial panic, the one that has cash flow reserves, clean records, insurance, proper beneficiaries, and enough simplicity that stress does not immediately become disorientation. That family is stronger than it looks. And strength that looks boring is one of my favorite things in finance. People love to ask me where the next big return is. Sometimes the better question is where the next unnecessary vulnerability is. Because eliminating a major vulnerability can improve a life more than finding an extra point of yield. This is especially true in crisis conditions. A household that must ask permission from one bank, one employer, one platform, one overleveraged property, or one outdated legal document is operating with hidden fragility. A household with multiple lawful routes to liquidity, clean records, modest reserves, diversified custody, and a legible plan is operating with something much more valuable. Sovereignty, not complete sovereignty. No private citizen has that in a modern state. But functional sovereignty, enough control that ordinary disruption does not become humiliation. That is what I want for you. I do not want you playing outlaw fantasies. I do not want you confusing concealment with wisdom. I do not want you trying to outmaneuver the law. That is foolish, dangerous, and unnecessary. What I want is simpler and much stronger. I want you to make your finances boringly resilient. Know the insured limits and titling rules at your banks. Spread meaningful liquidity sensibly. Keep a lawful emergency reserve. Use short-duration government obligations when appropriate for part of the reserve. If that suits your situation, review title. Beneficiaries, wills, powers of attorney, and trust with competent counsel where needed. Keep your important documents redundant and reachable. Understand the custody structure of any exchange or platform you rely on. Hold only what you can explain. Own assets that do not all fail for the same reason. Do not let convenience create concentration. That last point is essential. Convenience is one of the great seducers of modern financial life. One app, one bank, one broker, one login, one ecosystem. It feels elegant. It also creates single points of failure that only become visible when the day gets ugly. A strong system may be slightly less elegant. It is much more survivable. Now, I should say something about emergencies because too many people treat them as remote abstractions. Emergency is the word governments, institutions, and markets use when old rules suddenly become flexible. That is why the time to prepare is always before the word becomes relevant to your life. Once the emergency arrives, your options shrink. Once the levee hits, the freeze begins, the institution closes, the platform goes dark, or the legal problem ripens, you are no longer planning, you are reacting. Reaction is expensive, planning is cheaper. I have lived long enough to know that the public always assumes ordinary conditions will continue one more month, one more year, one more cycle. That assumption is what keeps people underprepared. They do not need a dramatic collapse to learn a hard lesson. They only need an interruption in exactly the wrong week. A person trying to make payroll, a widow waiting on a transfer, a family paying tuition, an older parent in the hospital, a business owner with vendor payments due. The crisis does not need to be national to be personal. That is another crucial truth. People prepare only for headlines. Wise people prepare for friction. Friction is enough to reorder a life if the structure is weak. This is why I always like liquidity, simplicity, and documentation more than dramatic financial cleverness. Cleverness breaks under stress. Good structure does not need to be brilliant. It only needs to remain functional. At this point, some people say, Warren, this sounds paranoid. Number paranoia sees danger everywhere. Discipline sees dependence clearly. I do not think every bank will fail, every account will freeze, every title will be challenged, or every platform will go dark. I do think households should stop building their lives as though these possibilities are so rare that structure no longer matters. Structure always matters. The person who organizes his life for continuity tends to look boring right up until the day everybody else wishes they had done the same. I have seen that enough to trust it. The greatest illusion in modern finance is that wealth is the statement. It is not. Wealth is the combination of value, access, durability, transferability, and the ability to support your decisions without too much outside permission. That is a much stricter definition. It is also a much more useful one. $1 million trapped behind bad structure can feel smaller than $200,000 managed wisely. A paid-off house with no liquidity can leave a person more fragile than a modest home, plus a clean reserve, plus simple legal planning. A retirement account with no documentation and no beneficiary clarity can create more confusion than comfort. An exchange balance mistaken for full control can collapse into helplessness at the exact wrong time. The intelligent family understands that the objective is not to hide from reality. It is to reduce unnecessary dependency inside reality. That is an adult project, and it is available to more people than they think. You do not need to be rich to build lawful resilience. You need to be serious enough to review, serious enough to simplify, serious enough to diversify custody, serious enough to keep records, serious enough to understand where fragility still hides. That is how ordinary people become much stronger than they look. Not by becoming invisible, by becoming organized. In the end, the most dangerous asset in a crisis is not always the one with the highest value. It is the one you think is unquestionably safe simply because you have never yet been denied convenient access to it. That is the lie I want removed from your life, because once you understand that convenience is not control, you begin building something much sturdier, and sturdiness in finance is a kind of quiet wealth that pays you back every time the world becomes less smooth than you expected.